On December 13, 2025, silver crossed $67 per ounce, and in that exact moment, 8 of the world's largest banks became mathematically insolvent, not because they were broke, because a rule hidden in the COMEX rulebook for 40 years had just been triggered. They owed 421 million ounces of silver. Only 47 million existed in their vaults. The math was impossible. The collapse was inevitable. This is the story of the 72 hours that vaporized the silver market. By the end of this video, you'll understand 3 things. First, what COMEX Rule 4.207b actually says and why it's been dormant since 1986. Second, how 8 banks accumulated 421 million ounces of short positions while the physical inventory collapsed to 47 million. And third, why December 13, 2025 wasn't a random day. It was the mathematical endpoint of a 40-year debt trap that finally snapped shut. Let's start with what actually happened that Friday morning. To understand how this happened, you need to understand how the COMEX silver market actually works. And it's not what most people think. When you hear silver futures, you probably imagine farmers hedging crops or investors speculating on price. That's partially true, but the majority of COMEX silver futures aren't traded by people who want silver. They're traded by banks using a strategy called naked short selling. Here's how it works. A bank sells a silver futures contract without owning the underlying metal. They're betting the price will go down. If it does, they profit. If it doesn't, they roll the contract forward, push the delivery date into the future, and hope the price eventually drops. This strategy works as long as 2 conditions hold. The price doesn't spike too fast. No one demands physical delivery. For 40 years, both conditions held. Silver stayed range-bound between $12 and $30, and most futures traders were speculators who never wanted physical metal. They just wanted to trade the price movement. But in 2020, something changed. The solar energy boom. By 2023, solar panel production consumed 140 million ounces of silver annually, up from 60 million in 2019. Electric vehicles, 5G infrastructure, military electronics, all required silver. Industrial demand was no longer cyclical, it was structural. Meanwhile, supply was collapsing. Global silver mine production peaked in 2016 at 900 million ounces annually. By 2024, it had dropped to 830 million ounces. Why? Because 70% of silver is mined as a byproduct of copper, lead, and zinc. When those metal prices dropped in 2023, silver production dropped with them. So by early 2025, the market was consuming 1.1 billion ounces annually while producing only 830 million. The deficit, 270 million ounces per year. Where did the missing 270 million ounces come from? Above ground stockpiles, government reserves, ETF holdings, and, most critically, COMEX registered vaults. In January 2020, COMEX registered silver inventory stood at 152 million ounces. By December 2025, it had collapsed to 47 million, a 69% decline in 5 years. But here's the key. While physical inventory was vanishing, the paper market kept growing. In 2020, total open interest in COMEX silver futures was 800 million ounces. By December 2025, it had exploded to 1.4 billion ounces. The banks were selling contracts against silver that didn't exist. And as long as no one asked for delivery, the fraud was invisible. But industrial buyers weren't speculators. They needed metal, not contracts. And by late 2025, they started demanding delivery. By November 2025, cracks were visible everywhere. First, the silver ETFs. SLV, the largest silver ETF, held 550 million ounces on paper. But when institutional investors started demanding audits, the cracks appeared. SLV's custodian, JP Morgan, couldn't provide vault receipts for 180 million ounces. They existed on the balance sheet, but not in physical form. On November 18th, Sprott Physical Silver Trust, PSLV, the only ETF that guarantees 100% allocated physical silver, reported that redemption requests had exceeded available inventory for the first time in its history. The premium to NAV, net asset value, spiked to 8%, meaning investors were paying $1.08 for every $1 of silver because they didn't trust paper contracts anymore. Second, industrial buyers started hoarding. In November alone, Chinese solar manufacturers imported 62 million ounces of silver, double the previous month. Indian jewelry fabricators, normally price-sensitive, began buying at any price. They knew supply was disappearing. Third, the bank started panicking. On November 22nd, Scotiabank attempted to close 40 million ounces of short positions by offering $5 above spot price for immediate physical delivery. No one sold. The metal wasn't available. By December 1st, the situation was critical. COMEX registered inventory had dropped to 51 million ounces. Total short interest, 401 million ounces. The ratio of paper claims to physical metal was 8.2 to 1. The market was a house of cards, and everyone knew it. The only question was, what would trigger the collapse? The answer came on December 13th at 10:13 a.m. When COMEX Rule 4.7b activated on Friday morning, the 8 banks had 3 options. Option 1, post 100% cash collateral. At $67 per ounce, 421 million ounces required $28.2 billion in cash. That sounds manageable for institutions with trillions in assets. But here's the problem. COMEX rules required the collateral to be posted in segregated accounts, meaning it couldn't be leveraged, rehypothecated, or used for other obligations. In a fractional reserve banking system, finding $28 billion idle cash is nearly impossible. Most bank capital is already deployed in loans, bonds, and derivatives. Pulling $28 billion would trigger margin calls across other positions, potentially collapsing entire trading desks. Option 2, buy physical silver and deliver. This was mathematically impossible. There were only 47 million ounces in COMEX registered vaults. Even if the banks bought every single ounce, they'd still be short 374 million ounces. And trying to buy 421 million ounces on the open market would cause a price explosion. Every purchase would push the price higher, increasing their losses exponentially. It's called a short squeeze, when the act of closing a short position makes it more expensive to close. Option 3, default, refuse to deliver. Declare force majeure, settle in cash at a capped price. This was the nuclear option. It would destroy confidence in the entire futures market. If COMEX couldn't guarantee physical delivery, why would anyone trade there? The market would collapse. But for the banks, it was the least bad option. Saturday, December 14th, emergency meetings began. At 9 a.m., the CEOs of the 8 short banks held a conference call with the CFTC chairman and the CME Group, which owns COMEX. The topic, can Rule 4.07b be suspended? The answer was no. Rule 4.07b was written into COMEX's charter in 1986 specifically to prevent exactly this scenario, banks selling unlimited paper contracts with no physical backing. Suspending it would require congressional approval, which couldn't happen over a weekend. At 2:00 p.m., J.P. Morgan's chief risk officer proposed a solution, cash settlement. Instead of delivering physical silver, the banks would pay the contract holders the cash equivalent at $67 per ounce. The problem? Many of the contract holders were industrial buyers who needed physical metal, not cash. And the largest holder, a coalition of Chinese solar manufacturers, had already announced they would refuse cash settlement and demand delivery. By Sunday afternoon, the banks realized they were trapped. They couldn't post collateral, they couldn't buy physical silver, and they couldn't legally default without triggering systemic collapse. At 6:47 p.m. on December 15th, HSBC broke ranks. They announced they would close their 58 million ounce short position by buying physical silver at any price. Within 2 hours, they had purchased 11 million ounces from private dealers at an average price of $94 per ounce. This triggered panic. If HSBC was paying $94, what would the price be when the other 7 banks started buying? By midnight Sunday, silver spot price had reached $120 on Asian exchanges. The COMEX opened at 8:20 a.m. on Monday, December 16th. Silver futures opened at $156 per ounce, a 132% increase in 72 hours. By 9:00 a.m., the price hit $213. Trading was halted for the second time in 3 days. At 11:34 a.m., the CME Group issued a statement. Due to extraordinary market conditions, COMEX silver futures will be settled in cash at the December 13th closing price of $64.87 per ounce. Physical delivery obligations are suspended pending regulatory review. In other words, the banks defaulted, they refused to deliver, and COMEX backed them. The immediate reaction was chaos. Silver mining stocks, which had been trading at 20x earnings, exploded. Pan American Silver was up 340% in a single day. Wheaton Precious Metals, up to 90%. But the real move was in physical silver. Dealers ran out of inventory within hours. Online retailers, APMEX, JM Bullion, SD Bullion, suspended sales. The premium for physical silver over spot price reached 85%. If COMEX said silver was worth $64, the real market was paying $120. By 5 p.m., the Rule 4.07b deadline, the silver market had effectively bifurcated into two separate realities. 1. Paper silver, COMEX futures, SLV, frozen at $64.87, controlled by banks, untradeable. 2. Physical silver, coins, bars, PSLV, trading between $120 to $180, controlled by whoever had actual metal. The 60-cent kill switch had detonated, and the aftermath would reshape the entire precious metals market. In the weeks following December 16th, three things became clear. First, trust in COMEX was destroyed. Industrial buyers who had relied on futures for hedging stopped using the exchange entirely. Chinese solar manufacturers announced they would only purchase physical silver through direct contracts with miners. The paper market lost its price discovery function. Second, physical silver vanished from the market. Refineries couldn't keep up with demand. Premiums stayed above 60% for months. By February 2026, the U.S. Mint suspended production of silver eagles due to lack of supply. Third, the banks faced consequences, but not the ones you'd expect. No executives went to jail. No institutions were fined. Instead, the CFTC announced market reforms that effectively legalized what the banks had done. New rules allowed cash settlement of any commodity contract during extreme market conditions. In other words, the system that allowed 421 million ounces of non-existent silver to be sold was not only preserved, it was codified. Here's the final truth that no one wants to say out loud. December 13th, 2025 wasn't an accident. It was the mathematical endpoint of a system designed to fail. Since 1986, COMEX has operated on a fractional reserve model. Banks could sell unlimited paper contracts as long as they maintained a small physical reserve, typically 5 to 10% of open interest. This worked when silver was a speculative commodity, but when it became an industrial necessity, the model broke. The banks knew this. Internal documents leaked in early 2026 showed that J.P. Morgan's risk models had flagged the short position as one unsustainable. As early as 2023, they kept selling anyway because the profits were too large and the regulatory penalties were too small. Rule 4.07b was supposed to prevent exactly this scenario. But it had a fatal flaw. The 67 trigger price was set in 1986 when silver was trading at 5 per ounce. It was never adjusted for inflation, never updated for changing market conditions. By the time silver reached $67 in 2025, it was already too late. The trap had been set. The banks had walked into it willingly, and when it snapped shut, the entire market vaporized. 421 million ounces sold. 47 million ounces existed. The math was always impossible. The collapse was always inevitable. The question isn't why the silver market broke on December 13, 2025. The question is why anyone believed it could survive this long. Here's what you need to understand. The financial system runs on confidence, not reality. As long as people believe paper silver is the same as physical silver, the fraud continues. But the moment someone demands delivery, the moment the math gets tested, the house of cards collapses. This happened with silver in 2025. It will happen with other commodities. It will happen with currencies. The pattern is always the same: unlimited paper claims against finite physical assets. And every time, the institutions holding the paper tell you not to worry, until the day they can't deliver. So here's my question for you. If 8 of the world's largest banks couldn't deliver 421 million ounces of silver when the price hit 67, what happens when the same dynamic plays out in gold? In oil? In dollars themselves? Leave your answer in the comments. And if this changed how you see commodity markets, subscribe. Because the $67 kill switch wasn't the end of the pattern, it was the beginning. The next vaporization is already being engineered. You just don't see the trigger yet.